4 years back, actually, I stumbled upon DeFi, and then I found it such a real foundational technology, and I was kind of already moving, exiting my first startup, which was my second life actually, and then I realized, wow, here's this opportunity to fix trust deficit in finance, from fixing trust deficit in food. I find sort of every time you scratch the surface of DeFi and go deeper into what people are building, it's absolutely fascinating. And I looked up what you're building, Darren, almost like a reference in interest rate, like LIBOR used to exist earlier, and now more of SOFR. Um, Tell us about IPOR. What's been the whole thinking around that, and why did you? I mean, you've had this long sort of time in the whole crypto digital asset space, seeing DeFi being born, and what was that made you think that there is a need for such a reference rate in DeFi?
First of all, the thing that you mentioned was the idea of trust, right? And the thing about DeFi and the thing about crypto, one of the kind of the core ethos, if you're like a hardcore Bitcoiner, is like don't trust, verify. And the whole purpose of the network, this Byzantine general's problem, is that you don't have to trust any node in the network because it makes corruption very inconvenient or infeasible, right? So the whole idea of trust is that actually you shouldn't have to trust. You shouldn't have to trust counterparties. You shouldn't have to trust, when this asset is sent from point A to point B. There's always going to be some trust assumptions, like for example, if you issue an asset, on the like for example, if you're wrapping an RWA, there's always the primary issuer risk. But the whole idea is actually minimizing the trust that you have to have in a system. And so that's a really nice kind of ethos to have in an industry, and especially
Hmm.
financial services. So if I take this kind of like long roundabout from the first crypto exchange to now,
Hmm.
actually, what did I needed the capital for was, my business partner was starting a risk recruitment firm, and we were recruiting financial risk managers. At this point, I was living in Chile. There was a financial crisis in Europe and Spain, and we were trying to get risk managers for very high level banking positions, and this was going further down kind of the risk manager's path. And it was also around this time in 2013 that the LIBOR scandal broke. So LIBOR, it was formerly the most important number in finance.
Yeah.
What is the LIBOR? LIBOR, London Interbank Offered Rate. It's
Hmm.
basically a rate that is typically a premium to the central bank rate, and it's literally a subset of banks talking with one another and saying, if I were to lend to you, this is the
Hmm.
rate that I would lend to you at. So that is a survey-based approach. It connects, a certain number of London banks, and they say, okay,
Hmm.
so this is the rate at which you can borrow
Hmm.
for different assets or currencies across different tenors. And so that is insanely important because it gives us a standard rate, and that rate was used to fix something like 300 trillion worth of deals, debt, and derivatives
Hmm.
used and basically pegged to the LIBOR. Uh, so if we go back to the idea of trust, trust was actually fundamentally broken in the LIBOR. So the LIBOR is insanely important because it gives you a standardized way of looking at cost of capital,
Hmm.
and you have a bunch of instruments that are basically structured off of the LIBOR rates, or were structured. Except bankers were literally writing each other messages over Facebook, say, "Hey, Sri, can you add or shave off 1 basis point?
Hmm.
I'll take the other side of that trade. I'll pocket the cash, and we'll walk off to the bank, and no harm, no foul."
Hmm.
And this was happening when the story broke. It had been happening for probably about 2 decades, right? So at
Hmm.
least since the '90s and probably before. So you have this trusted benchmark, which is being
Hmm.
manipulated by untrustworthy bankers for personal gain. But it doesn't mean that a benchmark rate is wrong. A benchmark rate is fundamental. It's the trust assumption that's the issue. So that has really been taken over by the SOFR. And that tells us that still this idea of a reference rate or the risk-free rate
Hmm.
is absolutely important for the formation of capital markets, especially along the interest rates.
Hmm.
Um, just what's we get rid of the corruption aspect. So in DeFi, we have a much more transparent aspect.
But
We
it
have
still wasn't risk free, right? There was the still a bank risk attached to
this
LIBOR as
is
well, right?
it was termed as the risk-free rate, right? So
Mm-hmm.
as as risk-free as you can get. So risk when you say risk-free,
Hmm.
you always take it with a grain of salt, but it's the term of the risk-free rate.